Okay, let's dive into something that has become a significant area of confusion and, frankly, stress for many people engaging with digital assets in the U.S. taxes.
Uh-huh. It's definitely a hot topic.
And we're not talking about the straightforward stuff like just, buying Bitcoin with U.S. dollars. We're heading into territory that feels counterintuitive to many.
Like using Bitcoin to buy a cup of coffee.
Exactly. Or maybe trading your Bitcoin for Ethereum. To the user, that might feel like just another transaction, right? Swapping one digital thing for another.
Yeah, seems like it should be simple.
But in the eyes of the IRS here in the United States, it's viewed through a fundamentally different lens. And yes, it absolutely can trigger a significant tax event.
Mm-hmm. That's where people get caught out.
This whole idea that crypto is somehow untaxed, operates completely anonymously, or, behaves just like regular money, well, that's a widespread misconception.
A very common one. And as we'll see from the sources we've looked at, the reality is far more complex. Plus, the IRS is increasingly focused on this area.
That's precisely right. And because of those very common misconceptions, this is where a vast number of people unintentionally run into compliance issues.
Right. And it's not like the rules are set in stone either.
Yeah.
The landscape isn't static. It's rapidly evolving with some truly significant new reporting requirements taking effect starting in 2025.
Seriously, big changes. Anyone involved with digital assets in the U.S. really needs to be aware of these shifts.
Absolutely. You can't afford to ignore it.
Okay. So, our mission today is clear. To cut through this complexity, we've pulled together a stack of source material to guide us. We've got insights from experienced tax pros, CPAs and tax attorneys.
Good stuff there.
Articles from financial education platforms, and crucially, official guidance published directly by the IRS itself.
Can't get more direct than that.
Think of these sources as our essential tools for navigating this deep dive, helping us understand the critical points and hopefully helping you understand the landscape well enough to avoid potential pitfalls.
And what's particularly fascinating, I think, is how much of the U.S. approach to crypto taxation stems from one single foundational decision the IRS made quite early on.
Okay, let's unpack this. What is that foundational principle that dictates so much about crypto taxes? Lay it on us.
It all starts with the absolute core rule. This was first established by the IRS way back in, notice, 2014-21, so 2014.
A long time ago in crypto years.
Right. And it's been firmly reiterated in more recent guidance, including the FS 2024-12 guidance. This rule states that for U.S. federal tax purposes, convertible virtual currency, and that includes the big ones like Bitcoin, Ethereum, stablecoins, even NFTs.
So pretty much everything.
Pretty much everything digital you might trade or use, it's treated as property.
Property, not currency. Okay, that seems like a small distinction on the surface, but I'm guessing it has massive implications.
Colossal implications, absolutely huge. Unlike traditional fiat currencies, like the US dollar or the euro, which are issued by central banks and function purely as legal tender as money.
Right, money is money.
Cryptocurrencies are classified as assets. They might function sometimes like a medium of exchange or a store of value, kind of like how we use currency.
Sure, people buy things with it.
But from a tax perspective, the IRS sees them right alongside other assets you might own. Think stocks, bonds, maybe even real estate. It's in that category.
So this property classification is the absolute key then. Why does it matter so much for someone just holding or maybe using a bit of crypto?
Because this single rule, honestly, it's the bedrock upon which almost all U.S. crypto tax law is built. It fundamentally changes how transactions are viewed.
How so?
Well, think about it. When you dispose of property in the U.S., whether you sell a stock, sell a house, or in this case, dispose of crypto, you potentially trigger a capital gain or loss calculation.
Right. Based on the difference between what you got for it and what you originally paid, your cost basis.
Exactly. If I sell a stock for more than I bought it, I owe tax on the profit. That's the capital gain. If I sell it for less, well, I might have a capital loss I can use.
Makes sense for stocks.
Now apply that exact same thinking to crypto. When you dispose of your crypto, and that could be selling it for dollars, sure, but also trading it for another crypto, or, crucially, using it to buy goods or services.
Like the coffee example.
Like the coffee. The IRS views that as selling a piece of property, just like selling stock. That transaction triggers a capital gain or loss calculation based on the crypto's value at the time you got rid of it versus your original cost basis for that specific chunk of crypto.
And this is profoundly different from how we use regular money. Like we joked earlier, the IRS doesn't care what I paid for the specific dollar bill I used for my coffee.
Precisely. The value of a dollar is, relatively stable, fixed by the government. Using it to buy something is just spending currency. Simple.
But crypto's value is all over the place.
Exactly. It fluctuates constantly against fiat, against other assets. Because it's treated as property, every single time you dispose of it for something else of value, you need to figure out if you gained or lost value on that specific piece of property since you first got it.
Wow, okay.
So if you're approaching crypto transactions thinking you're just spending money, you are immediately starting from a framework that just doesn't align with IRS rules.
And that sounds like a fast track to making mistakes.
It really is. Understanding this crypto as property rule is the absolute non-negotiable starting point. Get that clear? And the rest starts to make a bit more sense, even if it's complicated.
Okay, so if crypto is property, that makes the landscape of taxable events much, much broader than just selling it for cash, like you said.
Oh, absolutely.
What specific kinds of activities does the IRS consider a taxable event? Because they involve this disposition of property or maybe earning new property.
That's right. The sources, especially the official IRS guidance like FS 2024-12 and, articles from places like Investopedia, they make it crystal clear. The list of taxable events goes way beyond just cashing out to fiat.
So what's the trigger?
The core trigger is generally any disposition of the digital asset where you get something of value in return, or earning new digital assets.
Okay, hit us with a list. What actions should basically set off a little red flag in a taxpayer's mind saying, uh-oh, tax implications here?
All right, let's break down the most common ones. First, selling digital assets for fiat currency. This is the one most people get. You sell Bitcoin for USD. Easy enough. The difference between the dollars you get and your cost basis for that Bitcoin, that's your capital gain or loss.
Okay, standard stuff.
Second, and this is critical for our chat today, exchanging a digital asset for property, goods, or services. Like we keep saying, spending crypto. Using Bitcoin for pizza, Ether for a service, the IRS treats that as selling the crypto at its fair market value right then.
And using the proceeds, even if they're not cash, to buy the thing.
Exactly.
Yeah.
That triggers a capital gain or loss on the crypto you spent. Big one.
Okay, what else?
Third, exchanging or trading one digital asset for another. This trips up so many people because it feels like just moving things around in the crypto world.
Right, no dollars involved.
Doesn't matter. Trading Bitcoin for Ethereum, swapping altcoins, taxable event. You're treated as selling the first crypto for its fair market value. Boom, gain or loss. And immediately using those proceeds to buy the second crypto.
Wow, okay. That's huge.
Fourth, receiving a digital asset as payment for goods or services. If you're a business, a freelancer, anyone accepting crypto as payment.
Getting paid in Bitcoin, for example.
Yes, the fair market value of that crypto the moment you receive it is taxable income, just like getting paid in dollars. And heads up, your cost basis for that crypto then becomes that fair market value you just reported as income.
Got it. Income first, then basis set.
Fifth, receiving new digital assets from mining, staking, or similar activities. Earning crypto this way, generally taxed as ordinary income.
Not on capital gains.
Not initially. It's ordinary income based on the fair market value of the crypto when you receive control over it. This income event happens before you ever sell or dispose of that earned crypto.
So income when you get it, capital gain loss later when you sell it.
You got it.
That's it?
Sixth, receiving a new digital asset from an airdrop or a hard fork. When new tokens just appear in your wallet.
Free money.
Well, the IRS doesn't really believe in free money. If you receive new crypto from an airdrop or because a blockchain split, a hard fork, and you got new coins, the value of that new crypto you receive is typically considered taxable ordinary income when you get it.
Based on its value, then.
Based on its fair market value at the time of receipt. Now, one source, more, clarifies, if a hard fork happens but you don't actually receive any new crypto, then no taxable event for you from the fork itself.
Makes sense. No new property, no tax.
And lastly, there's a sort of catch-all, any other disposition of a financial interest in a digital asset. This basically covers any other way you might give up ownership or control of your crypto for value or gain new crypto value. Think maybe liquidating collateral in a DeFi loan you couldn't repay. That's a disposition.
Wow, that list is comprehensive. It really hammers home that the tax impact isn't just about converting back to dollars. It's about any time you move crypto out of your control for value or gain new crypto value.
Exactly. It's much broader than people think.
So what about things that are not considered taxable events? Those distinctions seem just as important to avoid, unnecessary panic or paperwork.
Absolutely crucial distinction. Knowing what isn't taxable saves a lot of headache. Generally, these activities don't trigger a taxable event. First, buying crypto with fiat currency. Just using your dollars to buy Bitcoin, not taxable itself. The tax part comes later, when you dispose of it.
Okay, acquisition isn't disposal.
Right. Second, holding crypto in a wallet or account. Just letting your crypto sit there, hodling, as they say, even if the price moons or crashes. No tax event. The gain or loss is unrealized, meaning it's not locked in until you sell or dispose.
Good to know. Holding is safe.
Third, transferring crypto between wallets or accounts you own or control. Moving your Bitcoin from Coinbase to Kraken. Or from an exchange to your personal hardware wallet. Not taxable. You're just moving your property between your own pockets.
But wait, I remember reading something about tracking this.
Yes. Crucial point. While the transfer itself isn't taxable, you absolutely must keep records of it. Why? Because the original cost basis follows the crypto to its new location. You need that trail for any future taxable event involving that crypto.
So the basis travels with the coin.
Exactly. And chain-wise adds a little wrinkle. While the transfer isn't taxable, any transaction fees you pay in crypto to make the transfer, like gas fees on Ethereum, might themselves be a tiny taxable disposition of the crypto used for the fee.
Oh, wow. Okay. Fees can be taxable too. Minor, maybe, but still there.
Essentially. Fourth, donating crypto to a qualified charity. Giving crypto to a registered 501c3. Good news. You can often get a tax deduction similar to donating appreciated stock, and the act of donating itself is not treated as a taxable disposal triggering capital gains tax for you.
So that's a potential tax benefit, not a liability.
Correct. And fifth, gifting crypto to a third party. Giving crypto away. That falls under U.S. gift tax rules, not capital gains tax for you, the giver.
So I don't pay capital gains when I gift Bitcoin.
Generally, no. You might need to file a gift tax return, Form 709, if the gift value exceeds the annual exclusion, which is $18,000 per recipient in 2024, going up to $19,000 in 2025. But you only pay gift tax if you exceed your massive lifetime exemption, $13.61 million in 2024, nearly $14 million in 2025. The recipient usually takes your cost basis, though there are some nuances there.
Okay, so for most gifts, it's about reporting, not paying tax for the giver.
Right. The core idea remains. Taxable event happens when you dispose of crypto for value, or when you earn new crypto. Simply holding, moving between your accounts, donating, or gifting within limits generally isn't a capital gains event for you.
That distinction is key. Okay, let's really zoom in on that point about spending crypto for goods and services. That's our title focus today, and it seems like the one that really catches people off guard.
Absolutely. Let's dive deep into using crypto for payments. As we've established, because the IRS classifies crypto as property, using it to pay for something, coffee, laptop, car, doesn't matter, is treated exactly the same as selling that property.
You're getting rid of the crypto.
In exchange for receiving other property, which is the goods or the service.
Yeah.
Multiple sources we looked at, Investopedia, Chainwise, Friedman plus Huey, River, they all explicitly state this. No ambiguity there.
Okay, so walk me through it. If I use, say, half a Bitcoin to buy something online, how is the tax actually calculated on that specific transaction?
Right. You need to calculate the capital gain or loss you realized at the exact moment you made that purchase.
How?
You take the fair market value, FMV, of the specific amount of crypto you spent, so the value of that half Bitcoin at the time of the transaction, and you compare it to your original cost basis for that specific half of a Bitcoin.
Okay, fair market value when I spent it minus what I originally paid for that bit.
Precisely.
Can we use some concrete examples, maybe one small, one bigger, like from the sources, to really nail this down?
Sure. Let's use an example similar to one from Chainwise. Imagine you bought one Ether, one ETH, a while back for $1,500.
Yeah.
Okay, that's your cost basis.
Got it. $1,500 basis.
A few months later, you decide to buy a new laptop. It's priced at $2,000. And you notice, hey, ETH has gone up. So you use that one ETH you bought to pay for the laptop.
Okay.
At the moment you hit pay or transferred the ETH, its fair market value was $2,000. Your original cost basis for that ETH was $1,500.
Right.
So when you spent it, you disposed of property worth $2,000 that only cost you $1,500 to acquire. That difference, $2,000 minus $1,500 equals $500. That $500 is a taxable capital gain you have to report.
Okay, wait. So even though I never saw $500 in cash, never touched dollars in that transaction,
It doesn't matter.
the IRS views it like I sold the ETH for $2,000 cash, made a $500 profit, and then immediately used that $2,000 cash to buy the laptop.
That's exactly the way they look at it. The $500 profit on the deemed sale of the ETH is taxable.
Wow. Okay, let's do the big example. Investopedia had one with a car.
Yeah, that one really drives the point home. Suppose you bought one Bitcoin, one BTC, several years ago for, say, $3,700. You held onto it.
Smart move back then.
Right. Then, maybe in 2022, when Bitcoin's value had surged, you decided, I'm going to use this one BTC to buy a car. Let's say the car was valued at $38,500, and the dealer accepted Bitcoin.
Okay.
Your cost basis for that BTC was $3,700. The fair market value when you spent it to get the car was $38,500.
Big difference.
Huge difference. The taxable capital gain on that single transaction is $38,500 minus $3,700, which equals $34,800.
$34,800 in taxable gain just from buying a car with Bitcoin I already owned.
Yes, that's a potentially significant tax liability triggered purely by using the crypto as payment, even if the car dealer took the BTC directly and no dollars ever changed hands between you and them.
That is eye-opening, and probably not what most people expect. What about other taxes, like sales tax on the car itself? Does using crypto somehow get me out of paying that?
No way. Absolutely not. Investopedia is really clear on this. Using crypto to pay for an item does not exempt you from any sales tax that would normally apply if you paid with cash or card.
So sales tax is separate.
Totally separate obligation.
Yeah.
It's based on the value of the goods or services being bought, calculated in the local currency. So in that car example, you could easily end up paying state sales tax on the $38,500 value of the car and owing federal and maybe state capital gains tax on the $34,800 gain from selling the Bitcoin.
Double whammy, potentially.
Okay.
This really highlights the administrative burden and the complexity, especially for smaller everyday transactions.
Right.
It implies that technically every single time you use crypto to buy even something tiny like that coffee we keep mentioning or a $5 app, you are theoretically triggering a capital gain or loss calculation on that tiny fraction of crypto, and you have to report it.
That is precisely the theoretical requirement under current U.S. tax law.
Oh.
Because it's property. And while, realistically, the IRS probably isn't dedicating resources to chase someone for failing to report a 50-cent gain on a coffee,
Probably not.
the rule itself dictates that it's a taxable event. This is exactly why accurate tracking becomes so critical, and frankly, why many people just avoid using crypto for small, frequent purchases.
It's just too much hassle.
It's a huge practical hurdle, created entirely by treating these volatile assets as property when they're used like a currency. People often opt instead for larger transactions where the gain or loss is more significant and the tax implications may be more obvious or worth tracking.
Okay. Given how counterintuitive that spending part feels, it makes total sense that there are other common pitfalls people fall into. Beyond just spending, what are some of the other major areas where people get tripped up, according to the sources?
Oh, there are several big ones. One of the most significant areas of non-compliance, highlighted repeatedly by sources like Chainwise, Investopedia, and Friedman plus Huey, is crypto-to-crypto trades.
The swap, Bitcoin for Ether or whatever.
Yeah, exactly. A huge number of investors, especially maybe newer ones, incorrectly assume that because no fiat currency, no dollars, are involved when they trade one crypto for another on an exchange, the transaction must be tax-free.
Like a simple exchange.
They hope it's like a tax-deferred like-kind exchange, maybe like swapping one piece of real estate for another used to be. But that's absolutely false for crypto under U.S. law.
So swapping BTC for ETH is definitely not a like-kind exchange.
Definitely not. The rules allowing like-kind exchanges for personal property, which crypto falls under, were basically eliminated by the Tax Cuts and Jobs Act back in 2017. It now only applies to real estate.
Okay. So for crypto,
the IRS explicitly treats a crypto-to-crypto trade as a taxable event. Full stop. You are deemed to have disposed of the first cryptocurrency at its fair market value at the time of the trade,
triggering a gain or loss.
realizing the capital gain or loss, and then immediately using the proceeds in value, even if not cash, to acquire the second cryptocurrency.
Okay, let's use an example, maybe like the one from Chainwise. Say I bought one Bitcoin for $30,000. That's my basis.
Got it. 30K basis.
Later, Bitcoin's trading at $45,000. And I decide, you know what? I want some Ethereum. So I trade that one Bitcoin for, say, 15 Ethereum on an exchange. No dollars touched. Still taxable.
Yes, absolutely taxable. According to the sources, in that scenario, you disposed of an asset, the one BTC, that had a cost basis of $30,000. Its fair market value at the time of the trade was $45,000.
Okay.
That $15,000 difference, the $45K value minus the $30K basis, is a taxable capital gain. You have to report that $15 a K gain on your tax return for that year,
Even though all I have now is Ether.
even though all you have now is Ether. And by the way, the 15 ETH you just received, its cost basis is now $45,000, the value at the time you acquired it through the trade.
Wow. That single type of transaction, just crypto to crypto, must be a huge driver of the tax gap everyone talks about.
It's estimated to be, yes, a major, major area of non-compliance, often unintentional because people just don't realize.
That's a really crucial point. Okay, another fundamental challenge you mentioned and the sources highlight is failing to track cost basis correctly.
This is maybe the most common and foundational mistake of all. Your cost basis, simply put, it's your original purchase price for the crypto plus any fees you paid to acquire it.
Seems simple enough.
It seems simple, but without an accurate cost basis for the specific units of crypto you sell, trade, or spend, you cannot possibly calculate your capital gain or loss accurately.
And the IRS wants accuracy.
They demand it. Common pitfalls here include just losing records of old purchases, maybe from exchanges that don't exist anymore, or not tracking the cost basis properly when you transfer assets between your own wallets or different exchanges.
Because the basis follows the asset, right?
Exactly. People forget that. And also, using incorrect or inconsistent accounting methods for bases like maybe mixing FIFO and LIFO without realizing it. Chainwise and Investopedia really hammer the need for accurate, detailed cost basis tracking. And River points out, again, transfers between your own accounts aren't taxable, but you need that basis trail for future calculations.
It all comes back to records. Okay, what about DeFi transactions? That whole world sounds incredibly complex anyway, let alone the tax part.
Otis, decentralized finance is dynamic, constantly changing, and yes, many activities within it create taxable events that are often overlooked or just completely misunderstood.
Like what kind of activities?
Well, think about providing liquidity to a decentralized exchange, or yield farming, lending, borrowing, interacting with different protocols. These actions often generate new tokens or rewards, and those can trigger tax obligations.
How so?
Chainwise and Friedman plus Huey give examples. Like when you deposit assets into a liquidity pool, you often get back LP tokens, liquidity pool tokens. If those LP tokens have a discernible value when you receive them, that receipt could be a taxable event itself.
Getting the token is taxable.
Potentially, if it has value. Then, things like yield farming rewards or staking rewards, which we mentioned earlier, interest you earn from lending crypto, those are typically taxed as ordinary income based on their fair market value when you receive them.
Ordinary income again, not capital gains.
Right. Borrowing crypto itself isn't usually taxable up front. But if the market tanks and the value of your collateral drops and your collateral gets liquidated to cover the loan,
Ouch.
yeah, that liquidation is treated as a taxable sale of your collateral assets. Boom, capital gain or loss right there.
And the platforms don't help much with this.
That's a major hurdle, Chainwise points out. These DeFi platforms are, by nature, decentralized. They rarely, if ever, provide any kind of tax reporting documents like a 1099. So the entire burden of tracking every single transaction, calculating the basis, figuring out the FMV of rewards, it falls squarely on you, the taxpayer.
This sounds like a nightmare.
It can be incredibly difficult without specialized tools.
And just to double click on earning crypto, you mentioned staking and mining rewards are ordinary income, not just capital gains when sold, right? I want to make sure we got that.
Correct. Absolutely correct. Explicitly stated by multiple sources, Chainwise, Investopedia, Friedman plus Huey, River. When you receive newly mined crypto or rewards from staking your crypto, the fair market value of that crypto at that moment is considered taxable ordinary income.
In the year you receive it.
In the year you gain control over it, that income needs to be reported. Then your cost basis for that newly earned crypto becomes that same fair market value you just reported as income. So later, when you eventually sell or spend or trade that earned crypto, then you'll calculate a capital gain or loss based on the difference between the sale price and that original FMV cost basis you established when you first received it.
Got it. Income now, basis set, potential capital gain loss later. What about miners specifically? Is it just income or?
For miners, yeah, sources like Moore and River discuss reporting this income. If the mining activity rises to the level of a trade or business, which it might if it's substantial and done for profit.
Like running a mining farm.
Exactly. Then the income might be reported on Schedule C, profit or loss from business. And the potential good news there is you might be able to deduct related expenses, electricity, hardware depreciation, etc., against that income.
Ah, Okay. Business treatment has pros and cons.
Right. For individual stakers just earning rewards, it's typically reported as other income on Schedule 1 of their Form 1040.
Okay. What about NFTs? They blew up pretty fast. How are those treated? Are they special?
Nope, not really special in the eyes of the IRS tax-wise. They are also treated as property, according to Chainwise and Friedman, plus Huey. The same general principles apply.
So if I buy an NFT and sell it later for more...
Capital gain. Sell it for less. Capital loss. Just like other crypto, assuming you held it as an investment.
What about NFT creators selling their own art?
For creators, selling an NFT they made or receiving royalties from secondary sales of their work is generally treated as ordinary income, potentially even self-employment income, which means self-employment taxes on top of income tax.
Oof. Okay. Ordinary income for creators.
And trading one NFT for another, also a taxable event, treated just like a crypto-to-crypto trade. Dispose of one NFT property, acquire another NFT property, calculate gain-loss on the first one.
Same logic. Is there anything unique about NFT taxes?
There's one potential wrinkle Chainwise mentions. NFTs could potentially be classified as collectibles for tax purposes.
Like art, stamps, or coins.
Exactly. And if they are deemed collectibles, then the long-term capital gains tax rate on their sale could be higher than for other assets. It could be up to 28% instead of the usual 0%, 15%, or 20% rates that apply to long-term gains on things like Bitcoin or stocks.
Ooh, 28% max rate. That's a big difference. Something to watch out for.
Definitely something to be aware of if you're dealing in high-value NFTs held long-term.
So whether it's a regular token or a unique digital picture, the property rules apply. And just quickly circling back, airdrops and hard forks can also create income events, you said.
Yes. As we touched on, receiving new crypto from an airdrop or hard fork where you actually get new coins is typically treated as taxable ordinary income based on its fair market value when you receive it and can control it. Free crypto isn't usually free from taxes.
Got it. Okay, we've covered a ton of different taxable events and common mistakes. It feels like the sheer volume and variety of these things, combined with that core property rule, makes meticulous record keeping not just important, but like absolutely essential.
It is arguably the single most critical aspect of crypto tax compliance. I can't stress this enough. Every single source we reviewed, Chainwise, Investopedia, professional firms like OCA, Friedman, plus Huey, they all hammer this point home relentlessly. You simply cannot accurately calculate your tax obligations or defend your filing if the IRS comes knocking without complete and accurate records, period.
Why is it so non-negotiable? I mean, what exactly do these records prove that's so vital?
They prove, well, everything you need to report accurately. Let me list it out. Good records allow you to.
Prove your cost basis. This is totally fundamental for calculating gains and losses. If you can't prove what you paid for crypto you sold, the IRS might just assume your basis was zero.
And tax the entire sale amount as profit.
Exactly. Taxing the entire proceeds as gain. You don't want that.
Track all sources of income. Records document the date and the fair market value of any crypto you receive from mining, staking, airdrops, or getting paid in crypto. You need proof of that income amount.
Enable accurate calculations. Having all the transaction details, dates, amounts, values, fees, allows you or your software or your tax pro to correctly calculate all the gains, losses, and income figures.
Provide support during an audit. This is huge. If the IRS questions your tax return, your detailed records are your primary defense.
Yeah.
Without them, you're kind of defenseless.
Okay, point taken. Records are king. What specific pieces of information need to be in those records for every single transaction?
The sources give a pretty comprehensive list. For each event, you generally need the exact date it happened, the type of transaction was a buy, sell, trade, spend, income receipt, gift, transfer between your wallets, etc. The specific asset involved, like 0.5 BTC or 10 ETH or that specific NFT. The quantity of the asset. Crucially, the cost basis of the asset you got rid of for sales, trades, spending, gifts. How much did that specific unit cost you originally, including fees? The fair market value, FMV, of the crypto at the time of the transaction. This is super important for income events, mining, staking, payments received, and also when you're spending or trading crypto. Ideally record this in US dollars. The value received either in fiat or the FMV of the other crypto, or the goods services you got when you sold, traded, or spent. The wallet addresses involved, especially for transfers. This helps prove you're just moving funds between your own accounts. Some notes about the source of income, stake reward from Lido, mined ETH from Ethermine pool, etc. And keep the paper trails for fiat movements, MA statements showing deposits to exchanges, withdrawals back to your bank.
That links everything back to the real world.
That sounds like an absolutely overwhelming amount of data. if you're even moderately active in crypto. How on earth do people manage all this? What are the best practices?
It absolutely is overwhelming. And honestly, trying to do this manually with spreadsheets for more than just a few simple buy and hold transactions, it's incredibly difficult, time-consuming, and super prone to errors.
I can imagine.
So the sources strongly recommend several best practices. First, export data regularly. Don't wait until April 14th. Go into every single platform you use, every exchange, every wallet that tracks history, every DeFi protocol you interact with, NFT marketplaces, and download your transaction history, at least annually, but quarterly or even monthly is much safer. Some platforms might limit how far back you can get data, or they might shut down. Get the data while you can. Second, maintain fiat records. Keep those bank and credit card statements showing the money flowing into and out of crypto platforms. Third, use crypto tax software. We'll talk more about this, but it's almost universally recommended. It automates so much of this. Fourth, secure storage. Keep all these records exported, CSV files, PDF statements, your own notes stored safely and securely, maybe encrypted, maybe backed up in the cloud. Fifth, retention, how long to keep them. The general IRS rule is 3 years after filing, but many pros, like OCA mentioned, say keep them for 7 years just to be safe. Some situations can extend the audit window longer than 3 years.
7 years, wow. Okay, and just to confirm, again, transfers between my own wallets, not taxable, but I still need to track them meticulously.
Precisely, because you need to maintain that cost basis trail. If you buy one BTC on exchange A for $10, transferred to your private ledger wallet, then later transferred to exchange B to sell when it's $50. You need to be able to prove with records that the BTC you sold on exchange B for $50 was the same one you originally bought on exchange A for $10. Not, say, some other BTC you acquired differently.
Yeah.
The records of the transfer transaction IDs, wallet addresses, they link that original $10 K cost basis to the final sale. It proves your gain is $40K. Not potentially $50 if you couldn't prove the basis.
Got it. The transfer records preserve the basis history. Given all this complexity, the sheer volume of data, it really sounds like manual tracking just becomes completely impractical very, very quickly for most people.
For anyone doing more than maybe 5 transactions a year, yes, it gets out of hand fast.
So using specialized software feels less like a nice to have and more like mandatory.
For the vast majority of crypto users who have transactions across different platforms, different types of crypto, maybe some DeFi or staking, yes, I'd say crypto tax software moves from highly recommended straight into the pretty much essential category very quickly.
And why is that? What does it actually do?
As highlighted by basically all our sources, Chainwise, OCA, Investopedia, Friedman, plus Huey, this software is built specifically to handle this mess. It automates the process of importing your transaction data, often via API connections or file uploads from dozens, sometimes hundreds, of different exchanges, wallets, and blockchain protocols.
So it pulls all the data together.
Yes. Then it helps reconcile that data. It applies the cost basis accounting method you choose, like FIFO, first in, first out, or specific identification across all your assets. It tracks your basis accurately even when you transfer coins between platforms. It calculates all the capital gains and losses. It identifies income events like staking rewards or airdrops.
And the output.
Critically, it generates the specific tax forms the IRS requires. Primarily Form 8949, which lists out every single capital asset sale or exchange, and Schedule D, which summarizes your total capital gains and losses for the year.
So it takes that mountain, that potentially terrifying mountain of raw transaction data, and turns it into the actual forms the IRS needs to see.
Exactly. It transforms the raw data into the required tax reporting format. It drastically reduces the hours upon hours of manual work, and, maybe more importantly, it significantly improves the likelihood of accurate calculations. Accuracy is paramount for compliance.
Right. And the sources mentions several specific software platforms people could look into.
Yes, across the various articles and guides we reviewed, platforms like CoinTracker, ZenLedger, CoinLedger, CryptoTrader, Tax, Coinly, and TaxBit were frequently mentioned as some of the leading providers in this space for U.S. taxpayers.
And presumably they have different features, different pricing?
Yeah, they usually offer different tiers of service depending on how many transactions you have and how complex your activity is. Like, do you need DeFi support, NFT tracking, margin trading support, things like that. Worth researching which fits your specific needs.
Okay, super helpful. We've covered the foundational rules, the minefield of taxable events, the absolute necessity of records, and the tools that can help manage it all. Now, let's shift gears to something that sounds like it's going to significantly change the game starting next year. Major changes coming in 2025. This sounds like a really big deal for anyone touching crypto in the US.
It is arguably the most significant development in U.S. crypto tax reporting how the IRS gets information to date. Starting with the 2025 tax year, which is the return you'll file in early 2026, new regulations are set to dramatically increase the IRS's visibility into individual crypto transactions.
Okay, what's the headline change here? What's a big one?
The introduction of Form 1099-DA. This is detailed in multiple sources: Chainwise, Investopedia, Friedman plus Huey, River. Starting January 1, 2025, U.S.-based crypto exchanges, crypto brokers, and potentially other service providers who handle crypto transactions for U.S. persons will be required to report user transaction activity directly to the IRS on this new form.
Wait, 1099-DA. That sounds exactly like the Form 1099-B that my stockbroker sends me and sends the IRS, showing my stock sales, proceeds, and cost basis.
That's precisely the analogy. The 1099-DA is designed to bring crypto transaction reporting much more in line with traditional financial asset reporting, like for stocks and bonds.
So no more relying on the IRS maybe getting data from an exchange through a lawsuit like with Coinbase?
Well, that might still happen, but the baseline reporting becomes systematic and automated for any exchange or broker covered by these rules. Before this, the IRS largely relied on taxpayers voluntarily reporting correctly or getting bulk data dumps after legal action. With 1099-DA, the reporting becomes routine, annual, and tied to specific taxpayers for covered brokers.
Okay, what's the real impact of this? How does this change things for the average person using, say, Coinbase or Kraken?
The impact is profound. It's huge. As Chainwise emphasizes, the IRS has incredibly sophisticated computer systems. They're designed specifically to match income and transaction data reported by third parties, like employers on a W-2, banks on a 1099 INT, or brokers on a 1099-B with what taxpayers report on their own returns.
The matching system.
Exactly. With 1099-DA, the IRS will suddenly have a direct electronic feed of data on potentially millions of crypto transactions, all linked to specific social security numbers or taxpayer identification numbers.
That sounds like it makes hiding or forgetting transactions much, much harder.
Exponentially riskier. Those automated matching systems will immediately flag discrepancies. If an exchange reports on a 1099-DA that you sold $50,000 worth of crypto, and your tax return shows zero capital gains from crypto, or maybe only $5,000, that's a massive red flag that's going to get automatically kicked out for review.
So expect more IRS letters if your return doesn't match the 1099-DA they receive.
Much higher likelihood of receiving IRS correspondence, like a CP 2000 notice proposing changes to your tax, or potentially triggering a deeper examination or audit if there's a significant mismatch. It dramatically narrows the compliance gap.
Now, River added an important nuance about that very first year of 1099-DA reporting, right? For the 2025 tax year filed in 2026.
Yes, that's a key point River highlights. For that initial year only, the regulations may allow brokers to report only the gross proceeds from sales or exchanges on the 1099-DA form. They might not be required to include the cost basis of the assets sold in that first year.
So the IRS will know I sold crypto and for how much, but maybe not what I paid for it initially.
Correct, for that first year, potentially. This means even with the 1099-DA, the burden could still be squarely on you, the taxpayer, to track and accurately report your own cost basis to calculate the actual gain or loss. The IRS knows you sold, you have to prove the profit or loss amount.
But that changes after the first year.
Yes. The plan is, starting with the 2026 tax year, transactions happening in 2026, reported on the 1099-DA you get in early 2027. Brokers will be required to report both the gross proceeds and the cost basis, similar to how stockbrokers report now on Form 1099-B.
Okay, but even when they do report cost basis, we heard earlier that their basis might be wrong, especially if I transferred coins onto their platform.
That is a crucial caution flag raised by River, and it will likely persist even with mandatory basis reporting. Exchanges can really only confidently track the cost basis for assets that were acquired directly on their platform.
If I bought it there, they know the price.
Right. But if you transfer crypto onto their platform from another exchange or from your personal wallet, or maybe it came from mining or staking or an airdrop years ago, the receiving exchange often has no idea what your original cost basis or acquisition date was.
So what will they put on the 1099-DA?
In those cases, they might just report the cost basis as $0. Or maybe they'll mark it as non-covered or basis unknown. If they report $0 basis and you just blindly copy that 1099-DA onto your tax return.
You'll pay tax on the entire sale amount, even if you actually had a loss.
Precisely. It could lead to a wildly inflated capital gain calculation. So the ultimate responsibility always remains with you, the taxpayer, to report the correct cost basis and the resulting gain or loss, even if that means correcting the information provided on the 1099-DA.
Which again highlights the need for your own independent records or using comprehensive tax software that aggregates data across everything you use.
Absolutely. You cannot just rely solely on the 1099-DA, especially for transferred assets. It's helpful IRS visibility, but not necessarily accurate for your actual tax liability.
Okay, so 1099-DA is a massive change in reporting and visibility. Are there other significant new rules coming in 2025 alongside it?
Yes, there's another really significant change, this one affecting cost basis tracking rules themselves. Also starting January 1st, 2025, Investopedia and River detail this shift.
What's changing there?
Previously, the rules were a bit ambiguous, and some taxpayers might have used methods that effectively pooled the cost basis of the same type of crypto, like all their Bitcoin, across different wallets or exchanges they owned.
Like an average cost for all my Bitcoin, maybe?
Potentially, or maybe using FIFO across the entire pool. The new rule explicitly mandates a required wallet-by-wallet or account-by-account cost basis tracking method.
Wallet by wallet. What does that mean practically if I hold Bitcoin on Coinbase, Kraken, and a ledger?
It means you can no longer, say, use the low-cost basis of Bitcoin you bought years ago on Coinbase to calculate the gain or loss when you sell different Bitcoin today from your Kraken account, even if it's the same asset type.
So the basis is siloed.
Exactly. The basis of specific assets is now formally tied to the specific account or wallet where they reside at the time you sell or dispose of them. If you transfer assets, say, move BTC from Coinbase to Kraken, the cost basis moves with those specific coins.
Okay, that makes sense.
But you must maintain records linking those specific transferred assets now sitting in Kraken back to their original Coinbase cost basis. You can't just average them in with other Bitcoin already in Kraken.
So this prevents some tax strategies, like maybe moving high basis coins to one account to sell for a loss while keeping low basis coins elsewhere.
It seems designed to prevent exactly those kinds of strategies that might involve selectively moving crypto between accounts with different basis pools just to manipulate the gain or loss reporting on a specific sale. It definitely makes tracking across multiple platforms even more complex if you're doing it manually.
Wow, okay. And what about crypto I bought before 2025? How does all that old crypto fit into this new wallet-by-wallet world?
Good question. Investopedia notes that taxpayers need to essentially sort out their historical basis before the rule kicks in. You must allocate the cost basis of digital assets acquired before January 1st, 2025 to specific assets currently held in specific accounts or wallets.
So I need to figure out which old purchase corresponds to which coins sitting in which wallet today.
Yes. Using either a global method or, more likely, a specific identification method if your records allow, by that January 1st, 2025 deadline. It means getting your historical records in order now and assigning that pre-2025 basis to the specific locations where those assets are held before the new rule takes effect.
Another reason good historical records are critical, what about choosing a cost basis method? Like FIFO, LIFO, specific ID, does that change?
Yes, that gets more granular too. River and Investopedia explain that starting in 2025, you'll need to choose your cost basis accounting method, like FIFO, first in, first out, LIFO, last in, first out, or specific identification, separately for each account or wallet.
So I could use FIFO on Coinbase, but the specificity on Kraken.
Potentially, yes. Which adds another layer of complexity to manage. You might even need to formally notify your exchange of your chosen method by January 1st, 2026, according to River.
What if I don't tell them?
If you don't specify a method, the exchange is generally required to report using FIFO by default on that 1099-DA form they send to the IRS.
But FIFO might not be the best method for my tax situation.
Exactly. Specific identification, where you choose exactly which units of crypto and their specific cost basis you're selling, can potentially be more tax advantageous in some situations.
Yeah.
But it requires absolutely meticulous records to prove you sold those specific units. If you can't prove it, the IRS could default you back to FIFO.
Okay, these 2025 changes, the 1099-DA, the wallet-by-wallet basis, they sound like a massive leap forward in the IRS's enforcement capability and just the overall compliance requirements for users. It makes me wonder, how active has the IRS actually been before these new forms and rules kick in? Was non-compliance really widespread, and was the IRS actually doing anything about it?
That's a really important question. And the sources, especially the article from More Tax Law Group, make it absolutely clear. The IRS has been significantly ramping up its enforcement efforts over the past several years, even with the previous limitations on data and clarity.
They weren't just waiting around.
No. As Moore notes, sure, the initial guidance was pretty limited, Notice 2014-21 way back when, then not much until revenue ruling 2019-24 and 2019. But meanwhile, the crypto market just exploded, right? Creating this huge potential gap between activity and reported taxes.
And the IRS noticed this gap.
Oh, they definitely noticed. More details, the landmark Coinbase case back in 2017. The IRS actually sued Coinbase, demanding extensive records on its users.
I remember hearing about that. What was the outcome?
The IRS presented evidence in court showing this massive potential compliance gap. They showed that despite Coinbase having millions of users and billions in transaction volume during the years they looked at, only about 800 to 900 U.S. taxpayers filed a specific form, Form 8949, to report virtual currency transactions each year.
800 or 900 out of millions, that's tiny.
Exactly. It was a striking statistic. And it convinced the court to order Coinbase to turn over detailed records for users who had transactions exceeding $20,000 in any year between 2013 and 2015.
Wow, that must have sent absolute shockwaves through the crypto community at the time.
It absolutely did. It was a huge turning point. It signaled very clearly. The IRS sees the potential non-compliance, and it's willing to use its legal power, its summons authority, to get the data it needs to identify users who might not be reporting correctly.
So that case basically opened the floodgates for more data.
It certainly set a precedent, and Moore mentions that following that, the IRS launched an LB&I compliance campaign that's large business and international division specifically focused on virtual currency. That signals a coordinated strategic effort within the IRS to tackle this perceived reporting gap through both education and, importantly, examinations or audits.
And I seem to recall headlines a couple of years later about the IRS sending out actual letters to thousands of crypto users.
Yes, that was the next big public step, happening in 2019. Based on the third-party data they now had almost certainly, including the data obtained from Coinbase, the IRS sent out over 10,000 letters directly to taxpayers.
10,000 letters, what did they say?
There were 3 different versions, as Moore explains. Letter 6173, 6174, and 6174A. They varied a bit in tone. Letter 6174 was more educational, basically saying, hey, we know you might have crypto. Make sure you're reporting it right. Here's some guidance. Letter 6174A was similar, but included a part the taxpayer had to sign acknowledging they received the guidance.
Okay, softer touches. What about letter 6173?
That one was more pointed. Letter 6173 stated more directly that the IRS had information indicating the taxpayer had virtual currency transactions that might not have been properly reported. It strongly implied that failure to review their past filings and potentially amend them could lead to an examination or audit.
So basically, we have data on you, fix your returns, or we might audit you.
That was the clear message. These letters put tens of thousands of taxpayers on direct notice that the IRS was actively using the data it had obtained to identify potential non-filers or underreporters in the crypto space.
And it sounds like the IRS's focus and enforcement efforts in crypto have only intensified since those letters went out.
Absolutely. Moore highlights that the IRS Criminal Investigation Division, CI, the ones who handle potential tax crimes like evasion.
The serious store.
Yes. CI has made virtual currency tax enforcement one of its key priorities. They are specifically targeting cases involving failure to report gains, yes, but also using crypto to conceal income or assets from other sources, and issues with businesses improperly reporting crypto payments they accept.
So criminal investigations are happening.
Yes. Moore even quotes the chief of IRS CI stating they're using their criminal enforcement resources to the fullest extent in the virtual currency area. That means they're not just looking for civil penalties like fines and interest. They're actively pursuing potential criminal charges for tax evasion in the most egregious cases.
That definitely raises the stakes. So how exactly are they tracing these transactions? I mean, blockchain addresses are pseudonymous, right? Not directly tied to names.
They are pseudonymous, yes, but that doesn't mean anonymous or untraceable. The IRS isn't operating blind here. As explained by sources like River, Friedman plus Huey, and more, they use a combination of sophisticated tools and partnerships.
Like what?
They work closely with blockchain analysis firms. Companies like Chainalysis are well-known examples. These firms specialize in analyzing public blockchain data. They can trace the flow of funds across different wallets and blockchains, identify patterns of transactions, link addresses that frequently interact, and sometimes connect clusters of blockchain activity to known entities like major exchanges, specific DeFi protocols, or even illicit services.
So they follow the money on the blockchain itself, but how do they link that to real people?
That's where the data from regulated entities comes in. The information from exchanges, especially with Know Your Customer (KYC) requirements. And critically, now with the impending 1099 DA reporting, provides the crucial link. When an exchange reports a transaction linked to your name, your address, your social security number, it allows the IRS to potentially connect that verified real-world identity to the activity happening on specific blockchain addresses that the exchange interacted with for your trades, deposits, or withdrawals.
So it's a combination, following the crypto flow on the blockchain, using analytics, and then using data from the on-ramps and off-ramps like exchanges to put names to the addresses involved in those flows.
Exactly. It's like piecing together a puzzle using both public ledger data and private data obtained from regulated intermediaries. The key takeaway is crystal clear. The IRS is actively building its capabilities. They are pursuing taxpayers they believe are non-compliant. And they were never just waiting for a perfect new crypto tax law to start enforcing the existing property tax rules they established back in 2014.
That's a really essential message from all the sources. They are applying the existing tax framework to this new technology and using increasingly sophisticated methods to find people who aren't playing by those rules.
You got it. Enforcement is real and increasing.
Okay. So given that increasing enforcement, that higher visibility, what are the actual consequences of noncompliance? And maybe more importantly, what can someone listening do if they suddenly realize, oh no, I think I messed up on my taxes in past years?
The risks of just ignoring your crypto tax obligations are significant, and they can be really severe. Failing to report your crypto income or capital gains accurately can lead down a few bad roads. First, an audit or examination by the IRS.
Nobody wants that.
No. That can result in significant penalties. We're talking penalties for failure to file on time, failure to pay the tax owed, accuracy-related penalties if you understated your income. These can be substantial, often calculated as a percentage of the unpaid tax. In some cases, if the IRS believes there was negligence or fraud, the penalties can be even higher, potentially even civil fraud penalties, which can be 75% of the underpayment.
Wow, 75% penalty.
Plus, accrued interest on the unpaid tax from the original due date, which can really add up over time. And, as we just discussed, in the most serious intentional cases, it could potentially lead to a criminal investigation by IRSCI, possibly resulting in charges for tax evasion, which carries jail time and massive fines.
Okay, definitely not worth the risk. All the sources chain-wise, Investopedia, Friedman plus Huey, River, Moore, they all seem to agree on these serious potential consequences.
Yes, the risks are very real.
So what if someone listening is having that oh no moment right now? They realize they likely underreported or maybe didn't report their crypto activity at all in previous tax years. What can they do? Is it too late?
Generally, it's not too late to try and fix it. If you discover errors or omissions on tax returns you've already filed, the standard procedure is to amend those returns. You do this by filing Form 1040X, amended U.S. individual income tax return, for each year that needs correction.
So I can go back and fix past mistakes?
Yes. River and Moore discuss this as the standard path. And Moore emphasizes something important. It is almost always better to be proactive. File those amended returns to correct the errors before the IRS contacts you about those specific errors or that specific tax year.
Why is being proactive better?
Coming forward voluntarily can sometimes help mitigate certain penalties, like the failure to file or failure to pay penalties, although interest will still likely be charged on any tax that was due back then. It shows good faith. However, filing an amended return isn't trivial. It's a serious step. You need to be sure your corrections are accurate and complete for all the years involved.
What if I already got one of those IRS letters?
If you've already received an IRS notice or letter, like that letter 6173 we talked about, amending requires an even more cautious and strategic approach. It might involve responding directly to the notice or potentially entering into a specific resolution program with the IRS. Because of these complexities, especially if multiple years or significant amounts are involved, or if an IRS notice has been received,
Get professional help.
consulting with a qualified tax professional before you file any amended returns is very strongly advised. Investopedia and Moore both stress this. They can help you assess the situation, ensure the amended returns are correct, and advise on the best way to approach the IRS.
Okay. What about individuals who maybe haven't just made an honest mistake, but perhaps intentionally didn't report? Are there still options for them to come clean without facing the worst consequences?
For taxpayers in that more serious situation, those who knowingly fail to report taxable income or perhaps engaged in more deliberate acts of evasion involving crypto, Moore mentions the IRS has a formal voluntary disclosure practice, VDP.
Voluntary disclosure, what is that?
It's a specific program, a pathway, for taxpayers to come forward proactively about significant past noncompliance. Essentially, you agree to cooperate fully, file accurate returns or amended returns for the disclosure period, usually the past 6 years, pay all the back taxes, interest, and usually certain civil penalties, like the accuracy penalty, maybe others.
And in return?
In return for coming forward voluntarily and meeting all the program requirements, the IRS generally agrees not to recommend criminal prosecution to the Department of Justice for the issues disclosed. It's a way to potentially avoid the risk of criminal charges, but it's a very complex process. It absolutely requires working closely with a tax attorney or a CPA experienced specifically in handling voluntary disclosures. It's not a DIY situation.
Understood. So navigating all of this, the property rules, the different taxable events, the record keeping, DeFi, NFTs, transfers, plus these upcoming 2025 changes, it just sounds incredibly challenging for the average person to handle correctly on their own. What tools and professional resources are really available to help people cope with this complexity?
We've touched on this throughout, but it really bears repeating because it's so important. First and foremost, utilizing crypto tax software is highly recommended and, frankly, for many people, almost necessary.
Why again? Just to summarize the benefit.
As all the sources Chainwise, OCA, Investopedia, Friedman plus Huey, River highlight, this software is purpose-built to handle the sheer volume and complexity of crypto transactions. It automates importing your data from exchanges, wallets, blockchains. It applies the cost basis methods correctly. It calculates the gains, losses, and income from all sorts of activities, including many complicated DeFi interactions. And crucially, it generates those necessary tax forms, 8949 and Schedule D.
It just takes the massive manual calculation burden away.
Exactly. It drastically reduces the potential for manual errors and dramatically increases the chances of filing accurate return based on your actual transaction history.
And those software examples we mentioned again were platforms like CoinTracker, ZenLedger, CoinLedger, CryptoTrader, Tax, Coinly, TaxBit.
Yes. Those are among the established leaders mentioned in the sources providing these services specifically for U.S. crypto tax reporting. People should definitely investigate which one best suits their specific mix of exchanges, wallets, and transaction types.
Okay, software is key. But beyond software, the sources also consistently seem to reinforce the value of getting actual human help, right? Consulting a qualified crypto tax professional.
Absolutely. This means finding a CPA, certified public accountant, or a tax attorney who either specializes in digital asset taxation or demonstrably has significant experience dealing with it. Not just any tax preparer will necessarily understand the nuances here.
Why is that professional help so important? Can't the software just handle everything if I feed it the right data?
The software is incredibly powerful for processing the transaction data and doing the complex calculations. That's its strength. But a knowledgeable human professional provides crucial interpretation, strategic advice, and quality control.
Like what specifically?
Well, they can help ensure your data is imported and categorized correctly in the software in the first place. Garbage in, garbage out still applies. They can advise you on choosing the most advantageous, but still compliant, cost-basis method for your specific situation. They can help navigate really complex scenarios that the software might struggle with, maybe certain obscure DeFi protocols, unusual NFT situations, specific business use cases of crypto, or international tax implications if you're dealing across borders.
And helping with past mistakes.
Yes, absolutely. They are essential if you need to address past non-compliance, helping you evaluate the risks and benefits of amending returns versus maybe pursuing that voluntary disclosure practice we discussed. They can represent you before the IRS if you face an audit. Essentially, Chainwise, OCA, Investopedia, Friedman, plus Huey, Riverliner, they all strongly recommend seeking professional help. Especially as your crypto activity becomes more complex or involves significant dollar values, they help ensure you're fully compliant, and they might even identify legitimate tax optimization strategies you wouldn't find on your own, all within the legal bounds.
So it sounds like the upcoming 1099 DA forms from exchanges will be helpful for IRS visibility, maybe a starting point for taxpayers. But relying only on those forms is risky due to potential inaccuracies, especially with transferred assets.
That's a perfect summary.
And true compliance really requires a combination. Your own meticulous records, likely using good crypto tax software to manage the data, and potentially getting guidance from a qualified professional, especially for complex situations or peace of mind.
That's the consensus from the sources, absolutely. Exchange reporting is improving. It will provide more data points, but it's not a perfect substitute for the taxpayer's own diligence. The ultimate responsibility to file an accurate return rests squarely with you, the taxpayer. Professionals and software are invaluable tools to help meet that obligation correctly.
Okay. Wow, that was a truly deep dive into the weeds of U.S. crypto taxation. Let's try to bring it back up and summarize the absolute key takeaways for everyone listening who might be feeling a bit overwhelmed right now.
All right, let's boil it down. Based on our journey through all those sources, the most crucial points for you to remember are probably these 5.
Crypto is property. Always remember this. The IRS treats convertible virtual currency as property, not currency. This single rule dictates why almost every transaction is potentially taxable, like selling an asset.
Property.
Got it. Number 2. Many events are taxable. It is absolutely not just about selling back to US dollars. Exchanging crypto for goods or services, that's spending. Trading crypto for other crypto, receiving crypto from mining, from staking, from airdrops, or getting paid in crypto. These are all potentially taxable events. They trigger either capital gains and losses or ordinary income that you need to report.
Way broader than just selling.
Okay. Number 3, record keeping is vital. I know we sound like a broken record, but meticulous records are non-negotiable. Dates, amounts, costs, values for all transactions. You need them for accurate reporting, for proving your basis, and for defending yourself if audited. And yes, crypto tax software is highly, highly recommended to manage this data burden.
Records are your shield. Use software.
Number 4. 2025 is a game changer, seriously. The introduction of Form 1099-DA means the IRS will have unprecedented direct visibility into your transactions from U.S. brokers. And the new rules forcing wallet-by-wallet cost-basis tracking add significant complexity and compliance requirements. The walls are closing in on non-reporting.
More visibility, more complexity. Be ready.
And then number 5, enforcement is real and increasing. The IRS isn't waiting. They are actively enforcing the existing tax rules using data they get from exchanges and sophisticated blockchain analysis firms. Ignoring your obligations carries very serious risks: audits, substantial penalties, interest, and potentially even criminal charges.
Okay. Property, broad taxability, vital records, 2025 changes, real enforcement. That's a solid summary. So yes, this landscape is definitely complex. It's understandably stressful for many people. But hopefully, being informed, understanding these key points is the essential first step towards navigating it successfully and avoiding those potential issues down the road.
Absolutely. Knowledge is power here.
It requires diligence, no doubt about it. But resources are available, that tax software we keep mentioning, and the expertise of qualified tax professionals can make a huge difference.
And it's just so clear from reading everything that the regulatory framework, the tax rules, are still playing catch-up with the sheer speed of technological innovation happening in the crypto space.
Which brings us perfectly to our final provocative thought for you, our listener, to maybe mull over. Drawing on some of the points raised in our sources about this ongoing need for clearer guidance, maybe even legislative reform. Here's the question. As this crypto ecosystem continues its absolutely explosive growth with new types of digital assets, new decentralized platforms, entirely new financial activities emerging seemingly every week, how effectively can these existing tax frameworks, largely based on rules for traditional property, truly adapt?
That's the billion-dollar question, isn't it?
It really is.
Yeah.
And what does that ongoing tension, that gap between rapid innovation and the much slower pace of regulation and legislation, what does that mean for you, the taxpayer, who's just trying your best to understand the rules and stay compliant in a landscape that feels like it's constantly shifting beneath your feet?
It's a fundamental challenge.
It's a challenge the industry wrestles with, regulators grapple with, and it's one that directly impacts every single person holding or using digital assets today and in the future.
Something to think about.